Yes, please go ahead.
Hello and good afternoon, everyone. We hope you and your near and dear ones are doing well and finding the strength to go through these difficult times and staying healthy and safe. My name is Bhaskar Natarajan and I work as a senior advisor at the Alliance for an Energy Efficient Economy. Before we start today's proceedings, I would like to share a few housekeeping guidelines. All the attendees have been kept on mute to ensure that we are able to hear the speakers clearly. This session is being recorded. You can see the session recording on our YouTube channel post the event. You can share your questions in the question box, which we will address in the open floor session. If we are in any case unable to respond to your questions during the session, we would definitely address your questions through the email. Having said that, let me start with today's topic, innovative financing for achieving Esco business resilience is of much importance today. Energy efficiency continues to be much sought after, and the national programs are going on in spite of all the challenges faced because of COVID. The Esco industry, the energy service company community, there continues to be hope that ESCOs will continue to be the mainstay of the efficiency business, even though they are facing challenges on a number of fronts. Today's session, we will be addressing the challenge relating to innovative financing, and we have three very interesting speakers lined up for today. Let me start by introducing Mr. Upendra Bhatt, who will be addressing us first. Mr. Upendra Bhatt is the co-founder and managing director of cKinetics, a mission-driven sustainability insight, innovation, and capital advisory firm. Mr. Upendra Bhatt is also the chairperson of the Alliance for an Energy Efficient Economy. Mr. Upendra is a go-to-market and techno-commercial specialist with expertise in technology evaluation and linkages. He has been very closely associated with developing infrastructure projects in South Asia and has worked on shaping innovative market-driven models for mainstreaming of technology and services interventions in the developing markets. Over to you, Mr. Upendra
Bhatt. Thank you, Bhaskar, for the introductions and for putting this session together. And thanks are due to you and Jayanta. I think AEEE is really, genesis of AEEE is really synonymous with the energy efficiency and more critically the ESCO segment, if I go back in history. And so this is clearly very core to the work that AEEE has been attempting to facilitate. And I think so this conversation is quite interesting for me personally, but I think for AEEE's membership at large. I think it's equally important in context of the changes we are seeing underway in the last couple of years, and more so, I think, accelerated through COVID. I think when we listen from Arjun, having spoken to him in the past, in the last few months, he will validate the fact that there is an increasing thrust towards more and more OPEX models, and therefore the role of ESCO and ESCO-oriented structures is becoming even more critical. And obviously, underpinning all of this is really the approach to financing for energy efficiency projects. And part of the challenge is energy efficiency has always been an integrated component to the technology procurement. It's not historically been a standalone component like a renewable, etc. So it becomes extremely difficult, even for a well-meaning, highly innovative buyer, to differentiate between a new equipment procurement construct versus what is EE by itself. Secondly, I think we all see technology improve by 2 to 3% on efficiency terms every couple of years. And so some of the EE measures that we start talking about if the project cycles become long in the sales process, they are almost deemed to be, normal process of evolution. So that's always hampered some of this aspect. But I think there has been, despite all of this, a fair amount of progress. I think we have kind of worked through certain models, we have identified certain structures, and increasingly from just buildings-oriented ESCOs, we are seeing industrial-oriented ESCOs emerging in their own right. So that is what I would focus on for the next few minutes of my talk, and then really would be keen to hear from Ram and Arjun, both one representing the supply side, one representing the demand side, as to what they are seeing, because our role, frankly, in my different hats outside of AEEE, my bread and butter come from cKinetics and our funding arm, Seekers. So it's a lot of will share my capacity to how I had shared a presentation, Bhaskar. I don't know if it can be put up or it can be enabled.
Jayant?
Yeah, we just
Just
got the
a
one.
minute.
Just a second. I think Bhairav needs to just give the access.
Yeah,
We'll just-
yeah,
Okay.
sure.
All right. Yeah. Go ahead.
Bharat, you could run it. I think you could run it. It's very easy. It's only 4 slides. So
yeah.
So you could run it and just
Well, Bhairav, you can give me the access. I can do that. Not a problem.
Okay, no, I have been.
You have? Okay.
So let me see if I can.
Yes, we can see it.
You can see it. So go to slide mode, slideshow mode.
Right, 1 second. Just
Yeah.
Is it visible now?
Yeah. Perfect. Go on.
All right. So really the discussion today is around how do you finance energy efficiency, and I think through the other panelists you will get to see other facets of this equation. But really the focus from how I see it really boils down to the challenges we see. And what are the challenges? I think invariably what we see is at the core of this is all about the Esco and EE providers not receiving the funding. And what our experience over last several years has shown is that you need specialized lenders who understand how to demystify this process. That's been the challenge. It's not a lack of financing lines. Arjun will validate that almost every banking institution or a large NBFC is keen to enter into energy efficiency or Esco. They just don't understand how to demystify it. The second facet of it is the technology dimensions and the business models, right? There are some which are well prevalent. Others, as the industry innovates itself, is really an amalgam of a different kind of constructs. Third, really, which really is a big bottleneck, is around the monitoring and verification. And how do you do that, and how do you integrate that into the credit pricing? Because that's what a lender or a financier really cares about. The last bit really is around just the perception of risk. It's not necessarily real risk, but it's a perception of risk, and who then kind of holds or is accountable, or what kind of recourse does a lender have in enabling these technologies. I think these are some of the components which then end up creating a situation where the cost of debt and the form and shape and the tenure ends up becoming far more in the conventional realm rather than something which is customized or customizable to the needs of an Esco like an Arjun or others, Smart Tech and others, right? So I think that's really the challenge with which we are operating in this space. There are obviously some green shoots. There are financiers who are increasingly specializing themselves in different kinds of EE technologies or segments. So it's not that it is all in the dark, but there is certainly significant potential to improve and enhance the form and shape in which financiers engage with this highly, I would say, lucrative market segment. I think these are low-hanging fruits. Over the years, I've seen every project do really, really well when it has been well crafted, well architected. So I think there's great opportunity, and I think the demand side is only more and more keen to go ahead with this. So I think that's what we'll focus on through the next few slides. Why isn't it going down? Sorry, guys, give me a second. There's something. There's some technical challenge for the slides not to move forward. I don't know. Okay.
Yep, we are done.
Yep.
Oh, okay.
Okay.
Yes, that's right.
So this is just a slide, a snapshot. This is some work that we had done jointly with AEEE some years back. But really, this is about different kinds of energy conservation interventions that we see being played out in the industrial settings more often than not. Each of these are well-proven technologies, but when you try and bundle it as a standalone EE projects, you end up seeing a whole variety of dimensions being reflected upon. And this is just a snapshot. Most of them, if you will recognize, have paybacks which are relatively midterm to short term. The ticket sizes really are not more than $500,000. And yet you see a significant reluctance to move forward at scale. Some of the Escos have now managed to create a mechanism with some chosen financiers, but really there's a wide opportunity here. Each of these represents, hundreds of millions of dollars of opportunities, which are near term. In most cases, the customers are willing to sign up now, and therefore, I think the market at large has an opportunity to do well. I think some of the ones which are called out for larger ticket size, like waste heat recovery or HVAC, etc., are again where the technologies are proven, the systems are proven. It is about how do you formulate the entire package together, and that is really the role of the Esco, and that is what differentiates, in my view, a good Esco from a Esco where the processes, systems, and the the SLAs are still getting evolved. So if I really look at it, one could craft this out into, we hear these terms all the time, whether it is deemed savings, guaranteed savings, shared savings. We can do a deep dive in this, but deemed savings are nothing but, empirically or otherwise, you've proven that each of these technologies create that level of saving, and therefore the customers buy it on their balance sheet. They could buy it with their own resources or get it financed. So it's really buyer's credit. And more often than not, you see this is how the banks look at it. You have other kinds of projects where there are still evolving levels of adoption, where because of the nature of the technology, you are expecting the technology provider to retain a skin in the game in some form or shape. Those are typically coming as shared savings, or if they are deemed savings, they typically are accompanied with supplier's credit. And for some of the larger projects, you do end up seeing increasingly now, but historically this was less so, are standalone or special purpose vehicles where you are doing independent project financing, and we have funded one or two there. Again, here I think the adoption has been slower than the opportunity that exists. HVC AC is guaranteed saving construct. I'm sure Arjun will touch more and more on this. This is the core of their evolution and their history, so I'm sure we'll get to learn more. But this is a very simple matrix in my view, and this is oversimplified. You would obviously have some variants of this overlapping across different kinds of savings model, but by and large, this is what holds in our experience in the market. So what are the drivers for scaling up Esco financing? One critical component is obviously the demand side, right? And I think the underlying principles here are, how do you ensure that energy conservation, which is talked about as a low-hanging fruit, actually ends up being seen as a management priority? And because it is not visible, politically, it has never become sexy enough, frankly. You are able to cut a ribbon or remotely launch a power plant, but in energy efficiency, you're actually saying you're shutting down power plants. So how do you make it exciting for people across the board to see it as a priority? So I think that's one. The second facet of this is, how do you create the awareness, and how do you kind of ensure that the selection process is a little bit more streamlined, because this requires a fair amount of maturity or savviness, and that takes time to evolve. What we have noticed is, wherever Escos have been able to simplify the solution packaging, rather than have multiples of caveats associated with their offer, we do believe the closure rates have been much, much better. We are increasingly working with some large demand guys in facilitating collective procurement models, because I think then designing a measurement verification protocol which is very specific to that intervention, making sure that the level of service provided for that intervention goes beyond the conventional deemed savings, etc. We have seen that come in quite handy. And all of these components are integral pivots or integral pillars to the demand creation process. I think the second one is how do you strengthen Esco ecosystem? I think Escos have existed and done well in this country, but they haven't necessarily scaled barring EESL, and which again has at its own, I would say, sponsors to enable that. So how do you kind of create this new age Esco model and an Esco industry at large, where you would be able to create Escos with reasonable balance sheets, where you are able to create parity between Escos and large industrial customers when it comes to contract negotiation, contract enforcement? How do you kind of create mechanisms where it is a more balanced play? And lastly, how do you also ensure that the Escos are having the ambition and the ability to take on larger and larger contracts by themselves? And therefore, how do you move the whole industry and conversations into a service-enabled contract and not just a equipment plus sale? I think that transition and that pivot is critical for a company to become a truly an energy performance contract organization, or in that sense. The last one really is how do you get capex going into the sector at a much larger scale than it has been done so far. Like I said, in more often than not, the standalone project financing deals haven't necessarily materialized here. A big part of the reason is ticket sizes are small. You don't have established benchmarks, or all the historical reasons that limit financing to flow into newer segments exist in this segment. Yet we have enough benchmarks, I would say, already in place, which could kind of be brought together to enable that. And that is what we have been doing. Like I said, our funding arm has been trying to do, in not just funding by themselves, but trying to bring in other mainstream financiers to co-lend and support larger projects. And we have done this in partnership with other Escos. So what we are doing is, while standalone projects are subscale as far as banks are concerned, they want project aggregation and need guarantees, find monitoring to be extremely tedious, and they do not have specialist people. They trust a sector specialist like the Seekers Finance to help catalyze this and help catalyze the construction and the stabilization on this. So that's the kind of aggregation we have been working with. And we believe it is these kind of innovative approaches which will allow greater and greater scale to come, because you do need mainstream financiers to come in. You of course have some sort of partial risk sharing facilities, guarantee facilities that SIDBI has, supported by the World Bank, but that hasn't necessarily been a game changer. I think what is needed really is how do you do project aggregation at scale? How do you create data-based interfaces for lenders to feel comfortable? And how do you kind of then create models where the return risk sharing equations are such where Esco and the financiers see themselves on the same side of the table and not necessarily grudge the kind of returns that an Esco or an equity guy may be making. I think most of the initial project work in platforms that are operating as Escos, such as Smart Joules, are all equity funded. Now, part of that equity has come from in-house sources, high net worth individuals, and we are increasingly now seeing some institutional equity getting interested in this space. So I do feel quite excited that over the next 24 to 36 months, a lot of institutional equity going into it. And I'm seeing some models where you are seeing steam as a service evolve. We are seeing, a turnkey energy management with energy efficiency as an underpinning evolve. So I do see that you would see larger and larger ticket sizes. The largest that we have enabled so far is somewhere in the 40 crore range, if I'm not mistaken. And that's what I believe would end up. So you'll see 10 to 40 crore kind of ticket sizes emerging increasingly over the next few years. So let me stop there, Bhaskar. I hope I've covered some of what you're hoping me to cover as an opening remark. But I would want really Ram and Arjun to reflect on each of the things that I've spoken so far. And then, of course, through a moderated discussion, happy to chip in with more thoughts.
Thank you so much, Mr. Upendra, for that presentation. Yes, it was a good overview, and now I'm hoping that Arjun and Ram will now get into more of the nuts and bolts. Before I hand over to Mr. Arjun Gupta, a very brief introduction. Mr. Arjun Gupta believes that we have to have a mission to eliminate India's need for fossil fuel, and he is on this mission hard at it. He started Smart Joules in 2014 to drive energy efficiency improvements across India's businesses and factories. He is at present the youngest member of the Executive Council of AEEE. He was recognized in 2014 as an Economic Times Young Leader by India's top CEOs, followed by several other recognitions. He has a master's degree from MIT after graduating from University of California, Berkeley. In 2019, Arjun started the Sustainability Mafia as a group of India's 50 leading sustainability entrepreneurs, multiply each other's impacts. Smart Joules has raised $4.9 million in venture funding for expanding its Esco business. This is probably the first time that an investment of this size and nature has taken place in the Esco business in the Indian context. This is a model example that we believe can help several other energy service companies and startups working in this space to explore similar options. Let me take this opportunity to congratulate Arjun, and let's hear from Arjun Gupta. What was the experience? What was the lessons learned, and where do we go from here? Over to you, Arjun.
Thank you so much, Dr. Bhaskar. If you could just confirm that my voice is audible, please.
Yes, it's audible. Perfect.
Okay, thank you. And my screen is also visible, correct?
Yes.
Great. So thank you so much for inviting me for this discussion. And Mr. Upendra Bhatt opened it really nicely and put a lot of really juicy topics on the table. I wish I could dive into each one of them and discuss them out in detail. Today I have a slightly different flavor of talk, not going too deep into Esco models, etc., but really focusing on a single issue, which is financing and fundraising, and really being open with the community about our experience with it and some lessons that we learned. And we really want to share that openly with the community and also encourage a lot more fundraising happening in the Esco and energy efficiency space going forward. So we have a lot of good news to share. We have some lessons to share and some positivity and optimism to distribute throughout the group. So I believe that our industry is at a very critical inflection point. We have to look forward to the next 10 years that we have in front of us. We have a lot of work to do in this decade. And, where I'm happy to represent today, how financing can be leveraged. We have to gear up at the beginning of this decade with financial resources in Esco companies and energy efficiency companies to actually, scale up our own services and offerings into the market. And later on, I'm really keen to hear from Ram about the industry side of it and how the demand side is shaping up, and also wanting to see more Esco and energy efficiency solutions coming up. So I'll start with my part. The first good news is that climate change is starting to attract the kind of expansion and money flowing into the sector that it deserves. In 2021, in the first the first month of 2021, we've seen as much investment as typically happens in a whole quarter, venture investment into climate tech companies around the world. So there is a big uptick in terms of the amount of money flowing into climate change and climate change solutions. So that is the first good news. Second is the richest people in the world are starting to invest aggressively. So it's not only venture funds, but some of the richest people in the world. And the third is that it's not only individuals and venture funds, but also the large asset owners, the people who actually control most of the money in the world. Large asset owners and investment vehicles and organizations like Morgan Stanley. So they did a little survey about sustainable investing becoming much more significant among the large asset owners around the world, and almost all of them unanimously say yes, sustainable investing is something we're considering more and more to do. The other really good news is that businesses are starting to take this very seriously. This is a very recent article about corporate houses, the biggest corporate houses in India, investing heavily into green and carbon-free technologies to cut emissions in their own operations. So this is the other big piece of news and a trend that will only increase along this decade as we go forward. So about energy efficiency in particular. So that was the whole overall context of climate change. But for energy efficiency in particular, I believe there are 3 points, and again, even more particular to Esco companies, there are 3 points to take note of. The first one is scale, that energy efficiency has more scale than anything else. Even if you look at the official Government of India climate abatement plan, about 51% of the abatement should be coming from energy efficiency compared to 32% from renewables. So really good news, right? We have a really scalable sector and a scalable area to work. The second that Mr. Upendra Bhatt also alluded to is that energy efficiency is very cost effective compared to all the other solutions that we have out there. It's typically one of the cheapest options out there, right? So we not only have scale, but we are also very, very cost effective. And the third one, which is of particular interest and what I see as historically a difficult factor, prohibiting growth of companies and limiting the uptake of energy efficiency. So the potential has always been greater than the actualization of energy efficiency. I see this point as actually being an opportunity for Esco companies. So what this picture represents is complexity. So energy efficiency is very complex. It's not one thing. Unlike solar PV or wind or any of the other renewables, it's a combination of many technologies, practices, etc., that need to come together to actually, do justice to the scale of opportunity that we have. So in this complexity lies the opportunity for Esco companies, right? How do we simplify this complexity for businesses who are running their own business and they have 100 other complexities to deal with? They don't want one more, right? They don't want another complex web of possibilities on how to save energy. So Esco companies, I see the primary job of Esco companies is to simplify energy savings. This is what Mr. Upendra Bhatt also mentioned slightly. So this is a big opportunity. How do we simplify the complexity of energy efficiency? So these 3 points together give me a lot of hope and positivity for the Esco industry. So I'm going to talk now about fundraising and share all the insights that we have gathered over the last couple of years since we have been at it with respect to fundraising. So first is that what we've heard and learned from the market. These are the words from actual big investors in the market. We are interested in this market. We have been tracking this space for a while. We are keen to invest in the space. This is the time to build a big business in energy efficiency. So this is what we are hearing from everywhere. So more good news. It's not only us as the suppliers and people who are from the industry who believe that this is a big opportunity, but the investment community is also saying the same thing. Now, I'd like to cover a particular topic a lot in detail, which is, with respect to equity fundraising. So as Mr. Bhaskar had alluded to, we have raised $4.9 million in venture funding in a Series A round. So I'm going to take you through a bunch of things relevant to that, to actual fundraising in an environment like today and for a company in the Esco space. So the first thing is, when you're thinking about fundraising, the first question that I think becomes very, very relevant is, is it the right time? I think that's the most relevant question. Is it the right time for us as a company to fundraise? Right. And I believe, every company that is thinking about fundraising should answer this question in a lot of detail. And I have a few things to share about, how do you know it's time, right? How do you know that now is a good time for me to fundraise as a company? So I believe it's 9 questions that one has to answer. So if you can convincingly say that you have a solid team, that you are going after a big problem, and it can't be just that, oh, energy efficiency is a big problem, but a little more concrete than that. So you have a solid team, you're going after a big problem, you have a differentiated solution, that differentiation can come from a number of sources: technology, business model, etc. Your differentiated solution has been repeatedly proven. So it's not only in one place that you've demonstrated that this works, but in multiple places. Your solution, which is differentiated, solving a big market problem with a solid team, can be quickly scaled up by acting on a specific and compelling plan. So financiers want to see all these things, right? The team, the problem, the solution. It has been proven, it can be quickly scaled up, and it can be scaled up through acting on a specific plan. Of course, every investor is looking for a return. So they want to see that there is potential, by acting on this plan to 10x their investment in 5 to 7 years. The other thing is that you as a company and as the top management of this company can be trusted. So there's a huge element of trust. And the final point is that there are other trustworthy people who believe point number 1 to 8. So, if you can convincingly tell this story, and, then I think you're ready. You're ready to go and raise money and go for, institutional financing, as Mr. Bhatt had mentioned. So the second thing, when it comes to mind when you're, at the early stage of thinking about raising money is whom to approach. Where do you go to raise money into your company? Equity money. I'm focusing mostly my remarks on the equity side and fundraising rather than on the debt side today. So when you're wanting to raise equity financing, then you're like, okay, who do I approach? So the short answer to that question is everyone is interested in funding this. So the first place you look is family. They will do anything to support you. So they are there. And this picture that I'm going to chart out is actually all the people who ended up investing in Smart Joules. And the dates are, how long the relationships date back to. So the first people who actually end up funding Smart Joules is family, and those relationships date back to 1954. So they do anything that can support you. The second is friends. They believe in you, and they don't want to miss out while you do really well for yourself. So friends also end up supporting you. This is obvious, family and friends. The third one is colleagues. The colleagues know you. They know that you can make things happen. They can be current colleagues or previous colleagues or senior colleagues or equal colleagues. They will support you in any way they can. And the fourth is high net worth individuals, people with a lot of money. They are usually very keen to support innovative people and innovative ideas. So that's the fourth place to look for money. Next is family funds. This category is typically not thought of a lot, but is an extremely powerful and promising area for more and more equity money to flow into our sector. Family funds want to build a better world for their future generations. And they also want to get in early on tomorrow's leading industrial solutions. So family funds express a lot of interest in businesses like ours. And they have made money, they have done business, they are keen to give you mentorship, and they have the money to invest. So that's a really promising place to look. Impact funds, their mandate is to create impact, and as Esco companies, we create a lot of impact in terms of energy savings and greenhouse gas reductions. And then venture funds. Venture funds like big markets, good founders, and scalable solutions. So, if we are certainly in a good market, if we have good team and good solutions, then venture funds are also very keen. So in this picture, you see all the types of funders who have ended up trusting Smart Joules with their investment. And to give a flavor of, it's not just one area that one can look at. Typically, we focus only on VC, but there's so many different types that can come together and invest and give you the kind of resources that you need to grow. And by the way, this is not the end of it. There are two other sources which are very, very very apt to talk about, which we also encountered during our fundraise. Beyond this, the next one is private equity funds. Private equity funds like to own large markets. They like to be the biggest guys out there. So private equity funds are also looking at this space very keenly. And the other one I'd like to speak about is large companies, large corporates. They like energy efficiency services, and they like to invest in businesses that they may one day want to buy or control. So that's another source of equity financing for smaller Escos that are looking to scale up. So, where to look for money? Anywhere and everywhere. And, on this slide, the other thing is dates. And why I put them out there is because I really believe that it's trust and relationships that you need to bring to bear to be able to do this. Next, I'm going to, I want to try and talk about timeline. So when you feel like you're ready and you kind of know where to look, what to expect in terms of timeline, and what was our story and experience with respect to timeline of fundraising. And this was quite an interesting timeline that we had. It started back in the summer of 2019. We were actually at an event organized by AEEE, and we had a stall over there, and one very large, one gentleman walked up to me and said, "We have heard really good things about Smart Joules." And I was really excited because this doesn't typically happen, that somebody from a big company comes and says, "Oh, we've heard something about your small company." And, I got very excited. And then they expressed some interest in talking about funding our company. So that's how it started. We weren't really looking for it. It came to us that let's talk about financing. And we said, okay, we are interested. Let's discuss. Summer of 2019. By the time it was April 2020, so many months later, and lots of discussions, etc. later, we ended up with a note that looked like this. This is a stock exchange disclosure, which shows that from this large company that we are investing in Smart Joules. We had finished all the negotiations, all the paperwork, signed the documents of financing, and sent them over for the counter signature. And so we thought that this battle is over, right? We have been able to raise money. It's been 6, 7, 8 months, but we have successfully concluded our fundraise. And then we got hit by COVID. So 1 or 2 days before the financing was supposed to officially close, we had a national lockdown. So we felt that, oh, all the 6 to 8 months of fundraising effort has gone to naught, and we're going to have to redraw our plans, and we're going to have to look at it again. So it was quite a heartbreak after a few months. So we're already 8 months in, and we're starting at point zero again. So we fast forward a little bit to October 2020. By this time, October 2020, we had been able to convince the original set of investors, which we started with friends and family, to invest some money in Smart Joules. So we started building some momentum into the company, into the fundraising that we were doing. And by October 2020, we got a very tempting offer. So that's what this picture is supposed to represent. So I mentioned that one of the options for financing is private equity companies. So we actually experienced that private equity companies are looking at this sector in a very serious way, and they want to scale up energy efficiency in India. So that it was a proposition and an option that came across our table as well, and we considered very seriously. And that kind of shows us that there is a bright future for this industry, because once you go from initial friends and family to venture funds, and then you want to really scale up and make big businesses, then private equity becomes really important. And we are already seeing that the funds that control a lot of capital are interested in this market. So that's what happened in October 2020. And finally, fast forward to February 2021 is when we were able to finally conclude on this financing. So the lesson from this that I would like to share is that it takes time, and anything can happen in the middle. So one should prepare accordingly. And I'm going to say a couple more remarks about this. One point is I'd like to share from this experience is what does it take for an investor to say, yes, we are ready to invest in your company? How do you get that yes? So the first point is the first 9 questions that I put out there. I think those are the most important. And I can't overemphasize this enough. If you yourself are convinced on these 9 points and you are solid on all of these grounds, that is, I believe, in today's market where there is a lot of financing available, that's 70% of the battle. The next is the timing works. The timing has to work not only for you, but the person investing. And a lot of times you'll find people who are really interested in investing, but the timing doesn't work for them. So the timing has to work. And the last one is that your story has to match their story in some way. So, either this can match in their investment thesis if it's a fund, or if it's a business that is investing, then their focus area, or their need. So, these are the three things that are important to get to a yes. A few other pointers from our experience that I'd like to share is, this is just a phase that, you're really desperate for something, and, you try to put up a front that, all is good, because when you're trying to raise funding, you're trying to impress the other person. But really, at the back of it all, you really are struggling and you really need money. So that is a bad time to go and raise money, because you're going to be exploited. And the other person is smart, they're going to smell it out that you really need your money, and you're in a bad negotiating position. So start a lot before you need the money. In our case, it took 2 years almost 2 years, or 1 year and 7 odd months. So why we were able to stay the course and still get a reasonable deal for ourselves at the end of the day is because we were not desperate for the money. So one of the lessons is, again, start much before you think you need the money. The other one is prepare to act fast. So a lot of young companies might benefit from this. There's a lot of preparation that you need to do before you start hitting the ground to fundraise. Some simple things are making decks, decks that can be shared, which can be read in 5 minutes, more comprehensive ones, and financial models, executive summaries that you can pass around everywhere, financial models, telling your customers and suppliers to be ready to get reference calls, and getting as much help as possible during this journey of fundraising. So, the more prepared you are to act fast, the better it is. And this is some homework that we have to do at our end. The important part here is to act fast. So nobody wants to, if you're fundraising for a long time in the market, the same deal is going to be passed around many different tables. And then everybody kind of in the market who's in the market to invest money knows that this company has been trying to raise money for a long time. If you are not prepared, at your end to go fast, then you kind of lose, some interest in the market, because people see that, oh, they've been trying to raise money for so long and they've not been able to do it, so there must be something wrong. So you don't want to create that kind of a problem for yourself. So that's why prepare as, to act as fast as you can when you have decided to plunge into fundraising. The next important point is get really good at telling a story. Again, a story that can be told in 2 minutes, a story that can be told in 5 minutes, 10 minutes, 30 minutes. You need to have all versions of your story ready to be crisply told, because you never know when you're going to encounter a person who might be interested, and you have to have the hooks for them to get interested. So a quick little anecdote over here is that, more than one of our investors actually came, we found them and got them interested within the first pitch, right, which took 10 minutes, and then that's it. That's the decision of investment is made, because you're generally trustworthy and you've got your story right and it strikes a chord with them. So you have to really get really good at telling your story to all kinds of people and in multiple lengths depending on how much time they have. The next lesson I would like to share is that this is a team sport. Fundraising is a team sport. So a lot of times what I've seen is that people go and try to do an independent job at this. They try to do everything on their own. So they'll be the ones who make the decks, they'll be the ones who make the financial models, they'll be the ones who make the lists of investors to reach out to, they are the ones who do the pitching, they are the ones who try to do the negotiation and the legal work. There's a lot of work involved in fundraising, and by no means should one try to do it all on their own. So very important at the beginning of trying to raise funds is to form a team. And minimum, you would need 2 people, and ideally you would have 3 to 4 people who all have a role to play in that fundraise. So that's the next important thing, and you're going to need definitely legal help and some financial help to be able to do this, apart from the founder who's going out and trying to tell the story and more of how this business is so exciting and answering those 9 questions that I put out earlier. The next interesting learning here is this one, that when we fall in love with somebody, we kind of know it, right? Is this going to work out? Like we have this feeling, there's a spark, right? Is this going to work out? Is it not going to work out? A lot of times we kind of in our guts, we know that this is not going to work out, but we hope that it works out. And fundraising is very similar. So when you meet somebody and you're trying to, talk to somebody about fundraising, their first reaction and response it tells a lot about whether the thing is going to work or not. So very important when you're fundraising is to protect your time, because again, you want to go fast. You want to try to get as many people as possible interested, actually interested. And you don't want to waste a lot of time on people who are on the fence and, who kind of give you the signals that they may not be interested, who are being non-committal in general. You got to move on from that and not waste time there. There's a lot of other people who will genuinely be interested and they deserve more of your time and attention. So one of these things is, lessons is don't waste your time. The next one is build momentum. So, we've seen this, this is a human, this is human nature. Everybody wants to be first to be second, right? So one very important, I guess one of the most interesting things we learned was momentum matters a lot. So if you can get an initial set of people to say, yes, we are ready. And, not only to say yes, but just to bank their money and get it in, then it is much more impressive for the next person that you're talking to for a bigger check that, okay, you're not telling the story that, oh, I have this amazing thing. And by the way, can you give me money? But you're saying, oh, I have this amazing thing. And 3 people have already invested and can you also invest? So that really, moves the needle very quickly in your favor when you're trying to fundraise. And, there's good reasons because the previous people who have invested money have done a certain level of diligence. So it's much easier to convince the next few. So the first one might be tough, but build momentum and own your timeline. Then, last couple of points are more just for entrepreneurs is negotiate. There's not just one point to negotiate on. Typically, we think a lot about valuation and, negotiating on valuation, but there are at least 50 very, very important points on which to negotiate when you're fundraising. So prepare to negotiate on all these points and, you can't take everything as gospel. Sometimes we get contracts in front of us and we get very excited and we're like, okay, this is great and let's go forward. And we ignore a lot of important details, but really take the time to negotiate. And, there's definitely with the spirit of having a good deal at the end of the day for both sides, but, know that there is a lot of room to negotiate on a number of points beyond this valuation. The next one, of course, is, from our experience of, the COVID coming and derailing our initial efforts, it's that it's not a deal until it's done. Until you have signed on the dotted line, received the investment, it's not done. So keep on it and don't take a break until you've completed it. So, that's what I wanted to share in today's discussion, and especially to encourage a lot of young companies to come up and be confident that the current investment climate, the current market conditions are all set up to make our businesses, small Esco energy efficiency businesses, scale up really fast in this decade. So I hope some of the lessons I've shared today would help people as they think about their own, equity fundraising journeys. And in the Q&A session, happy to talk more about this or some of the other very important subjects that Mr. Bhatt had alluded to in his remarks. So thanks a lot for the opportunity again to AEEE and turning it over back to AEEE, and really excited to hear what Ram has to share with us. Thank you.
Thank you so much, Arjun, for that very insightful presentation. I believe some ESCOs might want to do a private session with you probably for a much longer time, since there is so much I'm sure that you haven't shared that you probably might want to share with them. So before without much ado, let me now go over to Mr. Ram Vaidyanathan, a short introduction. Ram heads the environmental sustainability for Godrej Industries and associate companies and is responsible for driving the group's green strategy. He has over 12 years of experience in the sustainability sector across a wide range of roles. Prior to Godrej, Ram was the CEO of Wish Energy Solutions. Ram completed his MBA in Strategy and Marketing from the Indian School of Business and his Master's in Environmental Science from Singapore-Stanford Partnership. Over to you, Ram, for your views on the demand side.
Thank you so much, Bhaskar, and thanks, Arjun. That was really fascinating. I mean, if it weren't for this really an interesting role at Godrej, I might have considered jumping ship and going on to the entrepreneurial side. I mean, it's very, very inspirational what you just said. Coming from the demand side, I think it's very interesting what you mentioned, because I think it was Upendra who earlier mentioned this about the what do companies like Godrej look at? They look at what are my easiest and quickest ways in which I can achieve low carbon transitions. So you mentioned renewable energy and you mentioned energy efficiency. I think there was a study that was published looking at the overall potential of energy efficiency and already what has been unlocked over the last decade or two. And for the same investment, I think energy efficiency measures have yielded almost double the amount of savings, both in carbon and in terms of monetary value, as the investments in renewable energy. Yet it's one of those things that's almost taken for granted. It's almost palmed off to the operational teams within the manufacturing facilities to say, okay, it is last year 2% kiya, is saal 2% or reduce karo, in your specific energy. So at Godrej, what we realized was that there's a lot of hidden potential of energy efficiency in multiple operations. Just before I start on the specifics of what we've done and what we expect from the industry at large, just a brief background on what our targets and our sustainability journey essentially has been. I actually joined Godrej towards the end of their first 10-year journey of sustainability, where they have taken very simple targets, which are to reduce the specific emissions, to have carbon neutrality, to have water positivity, to have a certain amount of energy coming from renewable sources, and also to have zero non-hazardous waste ending up in landfills. The really interesting learnings towards the end of the first 10-year journey, which we've now set the strategy for the next phase, is one was we stopped looking at a 10-year window. We started looking at a 5-year window. I think that ties into something Arjun said as well in terms of being very agile in terms of what we're looking at, because both from a regulatory as well from a technology standpoint, this coming decade is going to be extremely dynamic. You will see that curve of adoption of these technologies go almost a much bigger slope than what had happened in the last 10 years, because many of these technologies are now at an inflection point where they're commercially quite viable. So I think even from the regulatory aspects, you will see, we expect at least, we are gearing up for a lot more regulatory aspects governing not just renewable energy, but also energy efficiency and certain minimum standards to which all industries must conform. And even with water, I would be very surprised if we didn't see a water price coming in the next 5 years across all the industries. So we took a shorter window for the next 5 years, and we're also aware of our commitments from what our investors and our stakeholders are asking, which is about globally aligning ourselves to guidelines such as the EP 100 commitment, which is to halve our energy intensity or double our energy productivity by 2030. We've been taking part in the challenge. What we realized was that there were a couple of big learnings. One was that after you hit a certain plateau, any gains you get are very, very incremental, and you're not really able to make any quantum shifts unless you really invest in very future-looking green technologies, which may not be commercially viable even after you include a carbon price. They still are. So we started incorporating risk-based costing. So the conventional view that most people have about investing in green technologies is looking at a shorter window, 2 to 3 years, because they are looking only at financial payback. When you start building in risk and resilience into the system, into your calculations, the window automatically goes from 3 to 5 years to a 10-year, 15-year horizon. So I think that has really helped us now get the buy-in, mainly internally, that we need to pursue energy efficiency, even though we're doing well on it, even though we've done very well on it. It is still something that we need to really, really push further on, because it could very well be the difference between being, surviving and thriving. So it's going to be the big difference between that. And for us, and I think this is Upendra, one very crucial thing he mentioned about risk in one of his slides. What companies are looking for, obviously, is to de-risk any investment or any operations. With renewable energy, it automatically became, now it's almost the de facto choice for all companies to go for OPEX kind of models, because it's the least risky option. And even for companies like Godrej, who generally we have always been cash rich, so have preferred to have capex investments, the mindset has shifted to more of OPEX, more from the fact that it's not the financial angle, but it's more of the operation maintenance and the almost outsourcing the entire non-essential portions of it to one trusted provider. So I think that what is very important is that to understand what are companies really looking for. They are not looking. Companies, to be very honest, they may say they're interested in this technology. They're not interested in technology. They're interested in the outcome. And how are you delivering the outcome, and how are you delivering outcomes from savings both in monetary terms and energy terms. And if you can guarantee certain outcomes to them at a certain cost, and that's the risk that they are passing on to the Esco provider, it's a no-brainer for most companies to take it up. And I think one of the models that Arjun brought to us, which was fascinating, was the entire idea of why can't the entire energy management, why can't you think of, say, a provider, an Esco provider, as an outsourced consultant or resource, as an energy manager who looks at your entire operations, and almost like another engineer or another technical person sits there and with the sole outcome of just looking at all the processes, all of the equipment that you have, looking at not just what are the upgradations required, but also process changes, real time. How can your processes become more efficient? Because essentially most of these systems today are reactive. We look at on a monthly or a quarterly basis, we look at energy performance and say, okay, this particular unit or this particular line, this is the place where we are expending the most amount of energy per unit of production. So is something we can do to capture this. But instead, what if we could have real-time information and real-time adjustments made to process parameters, which could, literally you are moving the time gap of making action from months or quarters to even more than days, down to the actual hour or even to the minute, and making those decisions. So I think that is where we also want to move towards. And so digitization, automation, outsourcing what is not our expertise. Our expertise is in running operations. That's where companies may have big utilities and they may think they're very good at being energy efficient. But somebody who has got their eyes solely on that particular subject will always be more efficient at doing that than somebody who's looking at 10 different things. So I think that outsourced model and looking at bundling or unbundling some of these aspects of not just energy efficiency, but even things like boiler operations. Today, many of our plants today are just purchasing steam from boilers within our facility itself, where the operation is completely the technology is outsourced to a third-party provider. And for us, the only thing that matters is, do I get X quantity of steam at this pressure, at these parameters, at this temperature for this many hours a day? That's all. I am not really bothered about whether which technology you're using or what fittings are going in. That is not really our concern. I think more and more you'll see companies like either invest in automation or even reduce their manpower or non-essential services within the factory, the utilities and all, and outsource that to third-party providers. And that's where I think Esco companies have a big role to play, where they can be those third-party providers who are focused purely on delivering outcomes. And the contracts are going to be framed in that sort of a way as well. So it's a very exciting time for us, because we are now looking at individual technologies such as hydrogen storage and things like that, as well as just conventional improvements on technologies to steam. The steam is, I would say, our biggest bugbear. It is one of those things where it's a constant pain in the neck. It's why everybody ignores it, because it seems to be one of those things that say, okay, it's not much of a cost, so let's ignore it. But if you start looking at it cumulatively, the amount of impact it has, not just on your energy usage, but on your attempts to go zero liquid discharge, on your waste, on your heat recovery systems, it's a huge problem. And the problem is that it's not one big problem, but it's a collection of lots of small problems, which is why it often gets ignored. So that having somebody or an organization or a company which has their eye on things like this specifically, that is where the real potential to unlock these inefficiencies are. I don't want to, I am not an energy efficiency expert by any stretch of the imagination, but purely looking at it from a sustainability perspective, and what we are looking to acquire as technologies is, outcomes. Bring to us the outcomes, de-risk the investments that we are making, and we in fact we are more than happy to even start off giving sections of our manufacturing on a pilot basis for you to work on, show us the results, most when they can be scaled up. So results and outcomes are everything. It's not about the technology. It's not about the it's not about the innovation or the technology. That is important for you, because that is what helps you unlock the biggest inefficiencies. But for us, the outcome is the only thing that is really important. So I think it's very simple. I realize that it may seem like a very succinct and very to the point sort of a thing, but this is exactly what companies like Godrej and even some of the other big manufacturing guys are looking at, in a very, very simple manner.
If I may offer just a couple of words about that, Ram. I think firstly, we have been really excited as the community in AEEE and our membership as well to hear the demand side of the equation come and share about what works for them and what gets them excited about energy efficiency. And I think you said you're not an expert in energy efficiency, but you certainly are, because the statements that you've made that just give us outcomes, and the positivity that you have also infused into this group is tremendous, and it's really going to inspire a lot of our members. So thank you so much for that. And Dr. Bhaskar and Mr. Bhatt.
I'm sure, Bhaskar, you may have a plan on how to moderate this, but I just wanted to echo, and you made some very interesting points. So first of all, echoing Arjun's point, I think customer always knows the market the best. You may need to steer that conversation. So I think one doesn't need to characterize it with a label of efficiency or A or B or C. I think the question is, in what form and shape does the product make sense? And efficiency is a product. It may need solutioning, it may need packaging of a certain kind, depends on the maturity of the market. You talked about the steam and the water dimensions, and it not being seen as a very cost-intensive, resources. But the reality is they are amongst the most cost-intensive ones. In fact, we at cKinetics on the advisory side had designed a framework called Value-Added Water Framework, which actually helps large organizations like yourselves unlock that. And we have seen that work really, really well, including on steam, right? Because normally people associate, okay, that's a cost of, discharge, that's a cost of steam. But in reality, it's all, if you come up with a smart mechanism of revectoring some of these circuits, you end up coming with it. And there is a lot of opportunity around heat exchangers and stuff like that. So I think your offer to the community at large and saying that you're open in people coming and presenting those solutions, piloting it out, and let the results show the way for everybody is, I would say, a very welcome sign. And I'm assuming, and just being optimistic as someone from the community, that you are representing how the demand side is now thinking, because a lot of people who are into conversation today and beyond are really looking for those signs, because markets evolve with signs. And so this is a very positive market sign. Thank you for that.
I just want to add to, because it's very critical you mentioned, because two of the factors that have really, I would say, changed how the customer is looking at the demand for the market is that one is the internalization of a carbon price and a water price. We haven't done the water price yet, but a carbon price has been done. So the conventional decision making for upgradation technology has moved from the production team to the sustainability team. That's where the real shift has happened. Now, it's the sustainability guys who are saying that, look, I need to figure in a carbon price into this because I am paying the cost for mitigation later on in the value chain. I need to bring that cost back into the production. Since that has happened, now internally we've developed a tool, for example, which is actually like it's a decision-making tool which factors in all the carbon price in your decision-making factor in your ROI calculation. The water price is something we still haven't been, and I would be very happy if you said you've done some work on this water value thing, because it is something that is the most, I would say, incorrectly priced resource that industries are using. Even if you go to any supplier or anybody, any consultant who looks at water price, they still go with the conventional, okay, what is the cost in terms of recovery, energy, all those things. There's a huge aspect of risk-based water costing which is not taken into consideration at all. Because what we have seen, this has happened actually at our Valia plant, the chemicals plant in Valia, is that because of the GIDC system, we were paying very less for water, so it was never really a major risk. But about 3 years ago, a drought happened, which, forget the fact that we had to pay higher for a tanker of water, we had to shut down operations for 2 weeks. So that kind of risk and that financial risk is never taken into the account when you look at water pricing. So I think water value, what you mentioned, is very, very critical, and these are the kind of things that help make the switch to technology, or switch to upgraded efficient technologies a lot easier, because you start including the real costs and not just the commercial costs that you see in front of you.
Subsidized, not even commercial.
Yeah,
it's not
cost, yes.
Somebody is paying for it. But Bhaskar, please, we don't want to hijack the.
No problem at all. I have a question from a gentleman, Mr. Subramaniam. I don't have the affiliation where he is from. He is asking that if we have an energy efficiency projects, how do we approach for funding under the Esco model? I guess he just wants to know what should be the first steps and what next kind of a situation. So perhaps Arjun, you would be the best person to answer, but the other two people feel free to jump in.
Sure, thank you. I'll take a stab at the question. Though it's a little general, I'll try to make it more specific. So the question is, if you have an Esco project, it's a good project, and how do we finance this project? Okay, so let me offer some remarks. First, if you are a new sort of Esco company, and I'll be as real with the current market conditions as possible. If you're a new Esco company with not too much experience having done Esco projects, then to look for money in the market to support your first project is quite difficult. So spare yourself the trouble of going to 100 banks and saying, can you fund this project or not? Just try to find anybody who trusts you to give you the money to fund the first project, generate some result, for even if it is for 2, 3, 4 months, generate some positive results from the project, and then that early money that you've got, right, from whoever knows you and trusts you, and you can gather that money from, that money can be returned relatively quickly. So I'll make it even more concrete. When we started off our business, we did not go into the market to try to raise debt for our first project, because we knew we have no track record. Nobody is going to trust and give us a loan for our first project before they see that this thing works. So what we did was, we went out to our, again, friends and family and said, can you give us some money for 6-8 months to start this project off? Okay, if this project fails, we will give you back the money somehow, but it will not fail. 6-8 months you give us this money. Once the project starts generating some value, then somebody will give a loan against the project. So, and then we'll pay you back. So that is a kind of a financial structure that worked for us for our early projects. Now, I would say, let me make it a little more general and talk about how a typical Esco project is financed. So, we try to finance the projects with a mix of equity and debt. The loan providers for a project will never give 100% loan. They will want some, what is called, skin in the game from your side. So typically we get loans for 70% of the investment that needs to be done, and 30% is financed through money that we have in the company as our resources and equity money. Now, I would also say, so where do you get this money from? The debt money or even the project equity money, what are the sources? You could get it from an NBFC. Bank is a little more difficult if you're not already a larger company with some track record. An NBFC is a better bet. And in the beginning of his remarks, Mr. Bhatt mentioned that Seekers is one such NBFC, and they are keen to invest in Esco projects. So there you go. There's a direct link for you to go and pitch your project, and they can be very creative in structuring the investment that is required for the project as well, right? So I think those are my overall messages, right? Don't waste time in going after big banks initially before you build a big track record. Focus more on people who trust you, and then NBFCs to raise the remaining amount that you need. And try to think of that I'll get debt only after the project is actually running, if it's your first or second or third project. I think Mr. Bhatt would have some good responses to this too.
Thanks. Mr. Upendra, just a quick response.
I think I'll take off from where Arjun left his third point. I think debt flows, once benchmarks are set at a company level, at a technology level, and at an enterprise level. And I think the issue here would be, I do not know the specifics of this particular organization, but if it is your first project on an Esco mode, you could have been an energy equipment supply company who has been doing erection and commissioning and are very familiar with the technologies. That will give some comfort. Going back to Arjun's 9-point menu of what a good entrepreneur should be or a good enterprise should be. But it would not give the comfort to a lender to come in just as yet. Almost every infra-oriented business at a platform level gets incubated with equity. Now, whether that equity is from your own sources or it is through, as we sometimes call friend, family, and fools, or it is from, early stage technology funds, could just as a function of what your own backgrounds or what your own networks are. But there are some specialist project financing companies, and none of these projects, frankly, will qualify as a standalone project finance. So it's a hybrid structure where you are getting project level debt, but within a corporate setup. You're not necessarily, because your own sponsor vehicle is not large enough to give comfort, etc. So people would prefer sitting in the one large company. But there are, beyond Seekers Finance, there's Tata Clean Tech, they have done some work. SIDBI has done some work. I know one or two other NBFCs like Encourage who have, Electronica Finance who have done some work on EE financing. So there are organizations who have financed EE projects, but each one of them would come with their own set of caveats around the kind of technologies they are comfortable with, depending on the kind of experience set or the kind of benchmarks that they have kind of come across based on their past lending. And therefore, the onus is on you as you present this project to present some of those facets, if you already have them, to inspire that confidence. I think running project is always easier to refinance because there is cash flow established. There are mechanisms around what the performance is, the construction risk, the initial performance risk is out. And despite all of that, I think a lender always would seek some recourse in case the project ends up not performing down the line as well, right? So you need to be prepared with those responses as well.
Yeah, thanks for that, Mr. Upendra. I have a question from Mr. Bhatt. What turnover multiple was Smart Joules able to achieve in the valuation? And this is going to be a great source of motivation for other Escos. Over to you, Arjun.
Arjun, can I come in for a second on that one?
Yeah.
For a second. You can give the facts. I don't have the facts, or rather, I'm aware of the facts, but let Arjun share it. But I think valuation is an art. It is not a science. It's a function of how well you present your story on those 9 points that Arjun presented. You could have 10th, 11th, 12th. But I think that's what drives the, at the end of the day, you're betting on an entrepreneur. And you're betting on what that entrepreneur and the team has been able to achieve. In case of Smart Joules, personally speaking, I think there's a very formidable team between the CEO and the CFO. And then, of course, what they've been able to achieve with the other colleagues. So I think that gives comfort, far greater comfort, and therefore a premium possibly, because you are not looking to plug in gaps in that team. Because part of the cap, so I think that's, but Arjun, you should share the data as you feel comfortable.
Thank you very much. So I'm going to address this question in two parts. First of all, I'm not going to give a direct answer here. I think that's more of a private discussion, and a one-on-one discussion, I'm very happy to share all the facts. But let me tell about multiples and valuations. I completely agree with Mr. Bhatt. This is not a science at all. And we have seen multiples of 50, we have seen multiples of 5. So that is kind of a 10x difference and even lower than 5. Right, so it would, first of all, so I don't think that sharing a number would even be healthy or helpful for anybody on what is the X that you can get in an Esco business. We've seen all kinds of offers being made to us as well. Offers that were higher than where we ended up, and offers that were 3x lower than where we ended up. Valuation, I would 100% agree with Mr. Bhatt and what he said about this subject. Thank you.
There are two questions that are related. I'm just going to post that, and any one of the panel members can feel free to answer. From Mr. Nishant Batra, who says, what according to you can be done to make Esco a viable business operation, both from the technological as financials? And then to this, there is a related question from Mr. Jigar Rathod. Is it credible even to consider raising funds through debt, given that the payments are always stuck with the projects in our industry? Over to any of you. I mean, would you like to start, Arjun, or anyone else? Go ahead.
I think the first part of the question, Ram is better positioned to respond to, and I think he did. Right? What, structuring a project, I think that's what I heard.
Yes. Right.
Yeah. So, Ram, would you like to take that one?
Yeah. So
I can take
essentially, what we're looking at is, like I said, outcomes in terms of it has to be aligned with what we are trying to achieve. It has to be aligned with, and the pace of delivery has to be aligned with what we want to achieve. I mean, it's what I mean by pace is what we are also looking at is how quickly can you help us achieve those reduction targets. There are technologies which require time. It requires a certain amount of scale or volume for you to be able to. You invest in it today, but you look at the actual deliverable over like a period of 4 or 5 years. But I think it's for how quickly you can deliver it, with how much confidence and certainty you can deliver it, and the fact how the reliability in terms of availability of the technology as often as possible. Because even if it's a low risk one, what we do not want is to constantly switch between operators every few years. That is not something that makes any customer comfortable. What we want is somebody who I can give the operations, shut my eyes and just sign the bill, or that comes at the end of the month and pay them. That's the limit of what we want to do. In terms of the operations, maintenance, reliability of service, the continuity of operations, that is what exactly we're looking at. Very simple.
Yes.
Yeah, great response there by Ram. So I'll more focus on the second question, which is funding projects with equity versus debt, right?
Yeah.
So I would zoom out a little bit on my initial, set of remarks about the sector. We are here to solve a problem of how India is going to reduce 51% of its greenhouse gas emissions, right? Targets, right? That's what we are looking at. That problem is not going to get solved by equity alone. It's not going to happen. So we have to build business models that are able to leverage debt. There's no choice. Okay, so we are not interested in 1 or 2 odd projects. We are interested in the national and the global problems. So to be able to address those without debt, there is no way it is happening. So we have to work in how to leverage debt in our business. That is one is scale of problem. Second is you want to create a profitable business, right? And you cannot generate systematically the kinds of returns that equity demands. You have to lower your cost of capital, and that can only happen with debt. Debt is the cheapest source of capital. So for both these reasons, debt is absolutely essential. Now the question is, how do you take on debt when you know that there is a certain amount of risk involved in the projects? So that as well I'll answer. The first is that you need to maintain healthy debt to equity ratios. You can't go all the way that I'm going to use 100% debt in my projects. And you need to look at it at a portfolio and a company level, right? At a company level, how many projects do I have running? How much debt do I have to service? And how much revenue do I have across my portfolio? And what is the risk level for these projects? Now, as a company, as an Esco, one of your key capabilities needs to be risk assessment and risk management. Not only assessment, but management, right? So you need to look at your portfolio and very deeply and well be able to assess what is the risk across my portfolio. And you have to maintain your debt levels at much lower levels than the risk that you actually expect to materialize. So definitely all your projects are not going to be successful. If we are going into an Esco business thinking that 100% success rate is going to come, it will not come. Some projects will definitely fail. So you need to look at a portfolio level, even assuming and putting the right kind of weightage on the risk. Is my company overall able to absorb what is the debt level I'm able to absorb, and then raise that debt in the best terms that you can. So that is kind of my response. It's a more general response, but those are the drivers to think about debt.
Thanks for that. I have one more question. There are a couple of more, but I'll come back to them later. This is from Mr. Sitaraman. Energy wastage in government buildings is very high, and there is enormous potential for ESCOs to do wonders here. He wants to know if AEEE can enable and facilitate for identifying these opportunities for ESCOs, and what can be done, and how can AEEE recommend and put their views accordingly. I'm going to request Dr. Satish, President of AEEE, to respond to this, and perhaps then I might come back to the panel members. This is directly to AEEE, and I thought Dr. Satish should probably attempt this. Over to you, Dr. Satish.
Hey, Bhaskar, can you listen to me? Can you hear me?
Yes, I can hear you very clearly. You heard the question, right?
Yeah, no. So I think you just repeat, because I was not, I was making some notes quickly, I think maybe 30 seconds.
Yeah, I'll just 10 seconds, I'll repeat. Mr. Sitaraman says government buildings is an enormous wastage of energy, and ESCOs can do wonders in achieving these savings. Can AEEE enable, facilitate identifying the opportunities for ESCOs and enable us to get these opportunities? AEEE can recommend and put their views accordingly. So I thought this is perhaps most appropriate question for you to answer, in addition to any other comments that you might want to make.
Have we lost Satish? I think he's online.
Hello?
Yeah, I'm on. I'm just turning on my, okay.
Okay,
so
thanks.
So I think it's it's a loaded question.
That's right.
I would say that clearly in terms of opportunities, we all know that government buildings do offer a pretty big chunk of pie, and I also want to highlight that many of the government buildings have pretty standard ECMs, I think, that can be installed. So I think one of the challenges I think that I have observed for private sector ESCOs to do government sector building is, where is the full, I think, ESCO expertise that is going to be brought into government buildings. And I think we have heard Arjun talk about that you need to have, you need to prove the value of your company. You need to prove that the scale can be achieved. So I think one of the challenges that I see, and I think when we have talked about this, is that a lot of the government building retrofit is still being talked about primarily in terms of energy efficient products and not like energy efficient solutions. And that, to me, in some respect limits, I think, the ability of a really good ESCO, which can provide, I think, the full range of solutions and financing to work and scale it up. And this is where I think why we feel that ESL has been able to corner that market, because they are able to provide some of these services, I think, at a lower cost, use bulk procurement, and many of the things that only ESL is able to do. Having said that, I do feel that there are a lot of views on what is the role of ESL. I think shouldn't they be playing some role in terms of enabling the ESCO market? And we have had some conversations about this thing. And I think their standard response is that it's very hard for us to outsource, I think, some of these contracts to ESCOs, because we are able to get lower, I think, rate of some of the equipment installers and other things done at a much cheaper level than if we will hire ESCOs. And it's a hard nut to crack for us, I think, in terms of how do you articulate the benefit of, I think, the ESCOs who are not just, I think, the equipment installers, right? I mean, that is, we don't want to demean, I think, what ESCOs can do, I think, in this. So I think it's a dilemma in that sense, that whether we should go after government buildings which are only looking for energy efficient fans, maybe super efficient fans, who are looking to replace lighting, maybe LED lighting, who are looking for, I think, air conditioners, maybe 5-star air conditioners and other things. And some of the bigger government facilities, which are like more energy intensive, are, I think, a more recent phenomena. So I think we would probably see, I think, greater opportunities for bigger contracts for the Escos there. So, so yes, I mean, in terms of course, AEEE wants to work in the Esco market, wants to facilitate, I think, the kind of, I think, success that we have seen with some of the Escos. But what is, I think, is that the government sector? Is that the large private sector, which is more energy efficient, offices, hospitals, hotels? Is that the market, or is it the industrial sector market, industrial utilities? Ram talked about steam. We can talk about compressed air. We can talk about pumping. We can talk about many of these things. So what is, I think, in the market? And my, I think, a sense from what I'm taking from Arjun's presentation also is that, is there some uniqueness, is there some expertise that I think the Esco can bring to the table, which will be hard to replicate, I think, by others? That can actually make you go far. Otherwise, if anybody else can come in, and if ESL can come and say that, hey, the kind of work that we do can be done by a regular contractor or this thing, then I think maybe, I think that is probably not the best place for the Escos to be. That's my personal, I think, opinion, but there are probably a lot of other organizations which are there. I'll take a pause. I may have like a few points on some of the benchmarks and M&V, and I think how do we go to private equity. I recall another seminar where I think we have requested Sanjeev Agrawal, who is another board member of Actis, and he has, I think, he said a few things that how can you go from venture capital to private equity and start attracting, I think, really the big players into the Esco financing. So I think, yeah, I'm just reminded of some of those comments. So maybe I think at a later, I think, a time, or maybe in some other forums as well. So back to you, Bhaskar.
Thanks a lot. I think we are running close to 5:30. I would just probably take one question from Mr. Milind Chitawar from cTech Solutions. Why is it that we are assuming that customers will not invest into E? And is there no future for the guaranteed savings model? Perhaps the first question maybe Arjun can answer, and Satish, you want to take a shot at the second one? We can do that, and then I think we'll try to. Go ahead. Sorry,
Bhaskar, I would suggest Ram to answer, since he's the customer. He would be best suited to represent that.
The first question, yes. Go ahead, Ram.
I lost the last bit of that. Can you just repeat the question once again?
The first question is that why are we assuming that the customer will not invest in E? And the second part is, why do we think there is no future for the guaranteed savings model?
I don't think we are. I mean, there's no. It's not a question of that we will not invest. Where that model is, like I said, it all depends upon the business and how easily, you know, how the cost of finance is for that business. Now, there's the cost of raising finance, and depends on the size of the projects. Now, like I mentioned earlier about renewable energy, it's not that, you know, the capex sort of projects or, you know, the other kind of models are not really working right now. But when the option of de-risking, when the option is there available where I don't take any of the risks of, or, you know, of raising the capital, investing it, finding all the you know, access to land and everything for that, that's for the renewable. But in general, if I don't have to de-risk it, like, I don't have to worry about the operations of the system at all. All I'm really concerned about is the, like I said, the outcome. My objective is to reduce waste. Now, I may not have the expertise in running the operations of the plant. If something goes wrong, I don't have the expertise in O&M. I don't know how to make the systems run to their optimum. This is where we would like the expertise of the other guy. That does not mean that there will be no other project other than the Esco model at all. Of course, that's absolutely not the case. It's just that wherever possible, where this is an opportunity, we would prefer going towards that, purely because I think it's smoother operations. It's less of a headache for customers, and that's the only reason why we want to go for that.
Bhaskar, can I add to that?
Yeah. Yes.
I think from our experience, what we have noted is wherever customers have a choice, then they would like to prioritize their capital for top line growth. right? So their own production lines need expansion, their own other businesses need diversification. So unless there's a very, very compelling financial proposition for them where they can prioritize this capital in a bottom line saving, they would invariably go for a top line growth. If there are no choices, then of course it's a different thing. And I don't think, Milind, that if you're listening in, it really depends, that it will be guaranteed savings that wouldn't have a future. It will continue to have, but as newer and newer technologies come, you would kind of move more and more purely from a risk continuum point of view to find a middle ground. And that is where alternate models would need to evolve to scale up, and I think the opportunity in the space is about breaking from that sheath of guaranteed savings and going beyond. I think that's what I think the larger expectation I believe within the marketplaces. But Arjun, you want to add to that before we turn it back?
Certainly. I think my response is that earlier historically we've been speaking about Esco as two models: shared savings model, guaranteed savings model. I think what we are trying to do, at least, is to say there is not one model, there is not two models, there is the model that works for the customer. And different customers have different priorities. For example, if you're a cash-rich company, you may want to invest in energy efficiency on your own, either fully or co-invest along with the Esco as well, right? So as an Esco company, you should be flexible and give the option to the customer, right? Would you like to invest? Yes, great. Would you like to invest 100%, 50%, 70%, 30%? What would you like to invest? And be clear about what is creating what value, right? And be very open and transparent. So I think that those are the keys. As long as you're transparent with your clients and you're understanding about where they're coming from and what are their needs, you can structure your model as a full shared savings or a whole guaranteed savings or anything in between. So I believe that is very important going into the market with that flexibility, and how you can get that flexibility is being transparent about the investments involved, the returns involved, and what is creating what value in the project at the end of the day, and have fair compensation for whatever you bring to the table. So that is my remark on this question. But thank you for it. It's a great question.
Oscar, maybe I'll just add. So I think one piece that I believe, and this is kind of something that I think all three speakers have touched upon, is that maybe I think the Escos need to be looking at results-based framework. Because my sense is that I think the market will move in that direction. I think when Ram is talking about that I want to outsource, I think in my non-core areas, I think he is looking for results, and results he will measure maybe I think in terms of the price that he pays for chilled water, or the price that he pays for steam. And I think if the Esco model starts to gear up towards, I think, delivering that kind of services, and for that, I think the benchmarks are going to be important. So whether it is lumen per watt, whether it is kilowatt per ton, or whether it is the electricity or the thermal energy that you consume to produce, I think 1 pound of steam at a certain pressure, I think that's the kind of information and what kind of measurement and verification regime you want to build in. I think for some customers who may be interested, other customers will say that we are not interested. You want to do deep savings, it's your problem. You have to deliver me, I think, this final output, and that's what we are really looking to do. So my sense is that maybe I think whether it's shared savings, whether it is, I think, guaranteed savings, these model, I think your financing will sooner or later start to give ways to sort of real-time pricing, I think, in terms of what the companies will start to demand. And the Escos and the companies who start to make this transition and who can deliver these services, they are going to be in much greater demand in future.
Okay, thank you so much, the panelists, for that comment. And Dr. Satish, just before closing out, I think we are close to 5:40. Is there any major high-level point you would want to interject at this stage?
No, I think I've made a couple of my points, so I think I'm done. I'm very happy. I think this is the kind of a discussion that AEEE wants to facilitate, and I think we have three different perspectives. I think that we shared for the broader community, and we believe that I think these are the kind of discussions that will be helpful and useful and relevant for the broader community. So back to you, Bhaskar.
Yeah, thank you so much, all the panelists. Before proposing a formal vote of thanks, I wanted to make a couple of points. I know that in this audience, we would have a number of ESCOs, as well as customers who probably would be looking for ESCOs, as well as other service providers who want to assist the ESCO community. I do want to inform the ESCOs that AEEE did over the last 8 months or so, reached out to quite a few ESCOs in terms of seeking their interest in going forward with equity financing. We did get an expression of interest from 3 or 4 ESCOs, but somewhere we were not able to connect them with the right people on the other side because of the issue of volumes and in terms of the issue of scaling up, and what the other side feels is the business opportunity for ESCOs. We are still going to pursue this, and I'm very happy that Arjun has, hit the first ball and for a 6, and then he's been able to generate this financing. I certainly would want all the ESCOs here to reach out to AEEE. We will once again move forward to reach out to the financing community. We did interact with 2 or 3 financing people, and we have an open-ended check from them saying, if you have the ESCOs, bring them to us. And certainly AEEE will want to do this particular activity. Let me stop here and say that once again, thanks to all the panelists for their time and their very, very exciting inputs, to the audience for joining us here for the last 1 hour and 45 minutes or so, and to my entire AEEE team for helping in working towards a very, very successful webinar. Thank you so much, and please do keep in touch with AEEE. Thank you.
Thank you.
Thank you.
Ram, thank you so much. That was fantastic. Really enjoyed it. Dr. Kumar.
All right.